Today's episode is brought to you by CAIA NXT. Later in the show, you'll hear more about how you can take the next step for your clients with CAIA NXT's alternatives education courses. But for now, let's get into today's interview. Joined today by Meb Faber, investor, author, and founder of Cambria Funds. Meb, welcome to Monetary Matters.
Thanks for having me. Good to be here.
I want to start off super bird's eye view. When you're talking to investors right now, what's your message?
This is as good as it gets. And I'm referring to the investing world, particularly stocks, right? Not referring to your politics, what's going on with your AI clone, your crazy uncle, all that stuff, just specifically with stocks. And a lot of people, I feel like, don't really appreciate, you look at social media trends, you look at the world, everyone's like kind of miserable. It's kind of a strange sentiment set up today. But this past 15 years has been one of the best periods in history for US stocks. We have a couple books coming out next year, these coffee table books looking at history of stock markets back to 1600. But even in the US, you look back at the last 100 years, you say, how normal is it for US stocks to do 15% a year for a decade or more? And it's been 15 years now. And the answer is it's happened, but it's so rare that the times it's happened all have names. You have the Roaring Twenties, everyone talks about 100 years ago, the Gilded Age. You have the Nifty 50 period for stocks in the mid-century, and then, of course, the internet bubble, and then today. The point being is that it's been good times. It's been a 10-bagger on U.S. stocks. But the temptation for all of us is to extrapolate that past into the future. And if we know anything about markets, it tends to rather be the opposite as far as on long time horizons and regimes. The good stuff turns into the bad and vice versa. So I would say everyone enjoy your Thanksgiving and holidays and New Year's, but say maybe don't expect 15% returns going forward forever in US stocks, and maybe start to look around a little bit on what hasn't been doing so great the past 10, 15 years.
When you focus on those periods of excessively good returns in the US, I can't help but think that a lot of them were followed by subsequent busts. So the 1920s obviously followed by the 1929 crash and the Great Depression, the Nifty 50 bull market of the 1960s followed by the inflationary wave of the 1970s and the subsequent bear market, .com bubble followed by the 2000 correction. Is it just an accident that periods, decades, let's say, of very good stock market returns tend to be followed by bear markets? In other words, is there something in the bull market that caused the bear market? Excessive credit growth, excessive optimism, or is it kind of just random and I'm attributing too much to it?
I think there's an easier analogy. It's like after the party comes the hangover. You once you drank all that champagne, the next day you wake up and the regret seeps in. What was I thinking? I didn't need a fourth, fifth, sixth glass of that. Like, that was dumb. I know better. So ditto with buying a stock trading at 200 times earnings. You'll look back and say, why did I do that? Like, my stupid neighbor, how, he was bragging about how much money he made on this meme stock, and I bought some and I lost 90%. Like, I know better. Like, why did I do that? It just, like, this long history. This is a story as old as time. When we are writing this book, we go back to stocks like VOC and the Dutch East India Company. And, the US stock market wasn't the biggest in the world, didn't even exist at that period, right? The crown was Amsterdam, and then it shifted to London. And after London, it shifted west to the United States for most of the 20th century, but not all of it, right? It shifted to Japan for a little bit and then came back to the US. But, these long periods of stock market returns, if you go back to 2009, nobody wanted stocks, right? The world was ending, Lehman was collapsing, on and on. And the 10-year inflation adjusted, what people call the Shiller P ratio, was like 12, right? Nobody wanted stocks. Well, fast forward 15 years, it's now 40. And it's funny because I've been reading some of these market outlooks year end from these big institutions, and they say, here's the stock market valuation. It's super expensive, but it hasn't yet exceeded 1999, as if that was like, you're safe, you're good. Things are crazy, but it's not as crazy as the most crazy it's ever been in the US history. So all that means is, look, things have been great. Maybe it's time to look elsewhere. And, it doesn't mean that markets have to crash. It doesn't mean that we're in for a period of zero or negative returns. But if you look back even to the decade prior, the 2000 decade, everything beat US stocks. US stocks were a stinker. You didn't lose all your money, but it was rough sledding for a decade. So it doesn't have to be that way. Maybe the robots save us, or maybe they take over and we don't have to worry about stocks anyway. But historically speaking, a simple way to think about it is just don't extrapolate the past into the indefinite future.
Do we have enough data to know that buying cheap stocks work? And that may sound like a ridiculous question, but if you have strategies that have very, you can test them very frequently, like buy stocks at 359 when the market closes and then sell them at 931 when the market opens the subsequent day. Like you can test that 365 days a year. Whereas the strategy of buying cheap stocks and then selling expensive ones, I mean, how many cycles do you have of cheap to expensive, 10, 12, 15? I mean, you know the exact number, but do we have enough data?
Yeah. Well, the good news is anything in markets, like you apply the common sense overlay, right? And there's very simple math and ideas that things would be crazy if the expensive stocks always did great, right? It wouldn't make any sense. Almost with every other line of business, like the entire financial system is built upon, these very basic logical tenets. Don't forget you also have foreign markets, right? And so there's 45 investable countries around the world. And when you do examine history, my favorite investing book, Triumph of the Optimist, you look at all these markets through history, not just with equities, but fixed income, other markets as well. You can extend it to collectibles. You can extend it to all sorts of cash flowing properties like farmland. Real estate's always the easiest one for people to grasp. You buy a house and you try to rent it out, or a building or a hotel or corporate, and you pay way too much for that. The math doesn't make sense. And it's the same thing in the stock market. At the end of the day, you're buying businesses. And people will forget that. Warren, who's retiring at the ripe old age of 95, understands this more than anyone. And he talks about, if you put a lens of, hey, I'm not investing in stocks, but I'm investing in businesses, I think it all starts to fall in and make more sense, because at the end of the day, there has to be some earnings and cash flow at some point. Now, they may be far in the future, which is what, a lot of the growth stocks are hoping and promising and thinking about. But, eventually you have to have those cash flows. And the thing about bear markets is it returns to that sensibility, the old Warren Buffett phrase of, you'll see who's swimming naked when the tide goes out. Well, the tide hasn't gone out in a long time. We've had 15 years of buy the dip, and you may have a little 10, 20%, and then it rips right back up. People we've seen historically, I don't think it's like a earthquake. I live in LA. It's like a, Richter scale, where every 10% down in stock market, it feels like people behave 10 times worse. But it really doesn't, the kink doesn't happen in my mind until down about 20 on the stock market. Up to 20, it's kind of, business as usual. But that's when people start to lose it a little bit. And we see that with all the sentiment surveys, like my favorite on the AAII, despite having near highest percent allocation to equities, or the highest we've ever seen for American investors in stocks, they're not crazy bullish euphoric yet. Maybe they learned their lesson. I don't know. But late 90s, at the exact peak when stocks were the most expensive they've ever been, people were most bullish. And when were they most bearish? March 2009. Like, you can't make up the sample to be worse in the exact opposite direction. So I think stocks are no question expensive, but not all stocks. The menu, it's not like you go to In-N-Out Burger and the menu is one choice, right? You actually have thousands of securities, and defaulting into the market cap index, it's not your only choice. There's plenty of other ideas: value, shareholder yield, looking abroad, looking at other asset classes, looking at other strategies that I think can be really thoughtful. And we're starting to see that this year. For a long time, US creamed everything, but this year you're starting to see some other stuff start to move ahead in the race.
I want to ask you about attribution of the stock market performance in absolute terms, but also in a relative sense across some factors. So, if like the US stock market has been outperforming the foreign stock markets, when you look at you're trying to attribute how much of that is due to excessive profit growth, how much of that is due to quality, And then how much of that is due to just popularity? Everyone loves US stocks because they keep going up. And because everyone loves them, they keep going up. And then because they keep going up, everyone continues to love them.
These type of analysis always depends on the start and ending point, but if you look at some of the attribution from some of the big quants like Cliff and others, they talk about, look, there's no doubt that the growth has been better in the US. So that's a tailwind. But there's also no doubt that the valuation multiple, which is just people paying more, has tripled since 2009. And when you look at these valuation metrics over the course of a decade, that can add 5, 6, 7 percentage points a year to the return. So just the fact that people are willing to pay more for a security or for a market. And the same is true in the opposite, right? If you go from 40 back down to 20, which would be somewhat normal, you would have a pretty huge headwind on stock returns. The interesting thing about foreign and emerging, you haven't seen much multiple expansion since 2009. They were about the same area as US was in 2009. They've just kind of gone sideways and up a little bit. So foreign, developed, and emerging are kind of around 20. Emerging's in the high teens. The cheap bucket's like 12, right? So the cheap bucket's still screaming cheap, despite being up 50% this year. Very quietly. You got to whisper that because no one knows it, or at least isn't clamoring for foreign or emerging market stocks yet. But very quietly, they're on this monster run. I think it's lost in the Nvidia being 5 trillion. It's lost in gold being 4,000, US market at all-time highs. But very quietly, things are starting to move underneath the surface. So the US has been exceptional. A lot of that, like you mentioned, there is a higher tech percent in the US. There's a better growth component, but also a very big part of that has been multiple expansion.
And how would you could choose your starting point, but if US earnings have compounded higher rate than the rest of the world, how much of the outperformance has been due to that versus a re-rating of the multiples just going up? And if the multiples have gone up, to what degree, if at all, by you, is it merited that the valuations are going up?
I think Cliff said it was like 80% multiple expansion. But what's great is like you can channel old Bogle, RIP to the goat of, democratizing investing. But he wrote in the 90s a paper that was demonstrating how to come up with expectations for future stock returns. And it's very simple. It's a formula. And anyone can do it. It's starting dividend yield, it's dividend growth, and change in multiple. So you can, in dividend earnings growth, same thing. You can actually split that out into real earnings growth and inflation. And then you type those in. And there's a couple things that are known, at least known current. It's current valuation, current dividend yield. Those are written in stone. The question is, what is it going to be 10 years from now? And is the valuation multiple going to go up or down? And is growth going to exceed or be lower than historical numbers? And then what, of course, is on a nominal basis, what's inflation going to do? And we're knocking on all-time low dividend yields in the US, 1.15. All-time low was 1.1. But there's been a slight structural change in the US. Companies do more buybacks. So the effect that has is it increases the dividend growth of the overall market, right? So it just moves it from one equation to the other. In foreign and emerging, you still have much, much higher dividend yields for those that care about that. But that is a very real structural change that I think is worth noting. So then the big question on those two things are just tell me what people are going to value stocks at in 10 years and tell me what earnings growth is going to be, and we'll know what that formula says. But if you look at Vanguard, we had Joe Davis chatting with him on the podcast recently, and they say, US market pretty muted returns, low single digits. Growth stocks, I think they were rounding almost to zero for the next decade. And they were pointing, I think, to much better returns in foreign and value and emerging market, which I would largely agree with.
And so, do you think that the earnings growth in the high tech flying stocks this year, last year, are unsustainable?
I don't know that I would say that. No, I don't. It's not out of the question. I mean, the challenge with markets is most people don't have a full understanding of history and what has happened. So they say, this is crazy. This has to be wrong. And the nice thing about being a trend follower, which is the other half of my brain besides value, is there's nothing stopping, by the way, earnings growth from accelerating. Profit margins, for example, have just kept going up and up. There's nothing stopping people from paying a higher multiple, right? If you look at Japan in the 80s, it hit a PE almost of 100. That's the US market doubling from here, okay? That's
I didn't know it
that's
was that high. I thought it was like 60.
it almost, and then it went 3 decades doing nothing, right? This was the largest stock market in the world, right, at the time, and it's still one of the largest stock markets in the world. So it's not like it's some tiny country. And Japan looks great now, by the way. Uncle Warren's been buying Japanese stocks. But so things can always get crazier. There's no ceiling to what can happen. And I think the challenge for most investors is you need to think in probabilistic ideas. So sit down at the blackjack table, say, look, this is the distribution of what's likely to happen. But I need to prepare my portfolio for the left tail, right? Things doing way worse than I expect. I also need to prepare my portfolio for the right tail, that things do way better than expected. And I think a big problem for a lot of people this year, for example, is the right tail outcome they haven't considered with assets outside the US, right? So gold's beaten stocks for 25 years, right? It's just been on a monster run and almost no American has any. Foreign stocks, which have underperformed by a mile the last 15 years, are crushing US stocks this year. And I mentioned the value stocks outside the US are up 50. That's a right tail event, right? Like those things are doing exceptional and almost no one owns any. I talk to US investors, foreign stocks about a third, they should be a third of your stock portfolio if you're an indexer. And I've talked to maybe 5 people in the last 5 years that are market weight or above in foreign stocks. US is only a quarter of world GDP. We did a poll on Twitter the other day, which isn't quite fair because there's a decent amount of my followers that are ex-US. But I said, how much do you put in the US? And it's like 2/3 of people overweight the US relative to the market index. Market index is already 2/3, right? Like you're dominated by US stocks. And so
To MSCI World or ACWI or something.
yeah, and I think ACWI in MSCI World, some of them are float adjusted. It's like 70%. So, but the problem is, that's a home country bias we talk a lot about, but that's everywhere. If you're Japanese, you put most of your money in Japanese stocks. Same's true with Brazilians and Brits and Aussies and everyone else.
I hope you're enjoying today's episode. As many of you know, the asset management game is changing. Increasingly, alternatives are eating into both stocks and bonds and becoming staples for all types of portfolios. With over 25 trillion already in alternative investments and 20 trillion more projected in the next few years, clients expect more than surface level knowledge when it comes to alternatives. That's where CAIA NXT comes in. It's a self-paced learning platform designed for financial professionals who need to understand and speak credibly about hedge funds, private equity, private debt, digital assets, real estate, and more. With CAIA, you'll learn directly from the leading allocators and alt managers shaping today's capital flows. So what you learn today, you'll use in your next client conversation. Whether you're an independent advisor or you're trying to get ahead of your peers in a larger organization, CAIA NXT gives you the edge to stay relevant. Visit the link in the description to get 10% off and start mastering alts for your clients today. Be future ready with CAIA. As an analyst of market history, financial history, what learnings can you draw upon to look at the current AI boom, and in particular the data center boom, the capital expenditure boom? So spending on chips, spending on data centers, the electricity, the cement, everything. What analogs come up, if at all, to the railroad boom of the 19th century, to, I don't know, maybe the 1920s, but in I guess the granddaddy of analogs, the .com bubble?
So it's the end of the year. So you start to see all the institutions writing their year-end outlooks, the year that was, the year that's coming. We have a free research service called the Idea Farm, and we kind of curate a bunch of these and send you an email every Sunday with the best ones. And I was reading some this weekend, and UBS had one, and they had a chart that we put on Twitter where they were talking about AI capex, and they compared it to the UK railroad boom, the US railroad boom, 60s and 80s, 1860s and 80s, by the way. They compared it to the US hardware, telecom booms, on and on. And then they said the AI projection of what we're spending on AI, but they did it as a percentage of global GDP. And interestingly enough, if you look at a lot of these prior booms, they got to 2, 3, 4, 5% of global GDP, and the capex is at 1. All right. So I was kind of tongue in cheek, put it on Twitter where I was like, maybe we're not spending enough on AI, right? But that's the thing about booms is you get massive capital allocation, you get massive capital misallocation, but it usually ends up benefiting everyone. Now, a lot of stock investors lose their shirt because they invest in these companies and they go down 80, 90%. But that's the story of markets, right? Markets are dominated by power law outcomes. If you look at the long history of stock market in the US, it's like 5, 10% of stocks generate all the gains. McDonald's, Walmart, Apple, Nvidia, right? The problem is often by the time they get to the finish line of being the biggest, they're usually expensive. They're the incumbents. They got a target on their back. If you want a secret way to outperform the S&P by 0.2% per year, I'll tell you listeners, and don't share this, right? Because all the hedge funds will pay you billions of dollars for that. It's just you take out the largest stock. That's it. The largest stock in any market or country or sector or industry on average underperforms the index by about 3 percentage points per year for the next decade. So getting to be the biggest historically is a terrible crown to wear because you're usually expensive. Market cap weight, you remember, the only thing about market cap weight is price of the stock. So by the time you get to be a $5 trillion company, usually that means you're expensive. Anyway, so it's a weighting mechanism. What will the market decide? Look, who knows? Maybe Nvidia will be the world's first $10 trillion company. We have a chart that we talk about on Twitter where we say, here's all the milestones. Here was the world's first $1 million company. Here was the world's first $10 million company, the first billion. And it's a laundry list of names you've heard of and have not heard of. And chances are that, 10, 50 years from now, we won't be talking about Nvidia. We'll be talking about someone else. But, what is the right amount of spending? I don't know. We'll know in retrospect, that's for sure. In 10 years, we may say, man, can't believe these people spent so much on these LLMs. Like no one even uses these, right? We went down this other road. Or maybe people say, wow, it was really smart of OpenAI to spend unlimited budget on this because they captured the lion's share. Who knows? I don't. But I said this about a year or two ago. I said, the assumption that almost everyone makes is that all of the developments will happen in the US. Like the US is going to win this. And I said, I don't know why people make that assumption. I said, someone in China or India or Singapore or Brazil or Germany could make an exponentially better AI. And then it's recursive and it feeds upon itself and reflexive. And then all of a sudden, they say, you know what? Actually, we're not going to share it. We're just going to keep it. Right. And it translates into medicine and energy and technology. And then you saw this happen with DeepSeek, right? The Chinese stock market a year or two ago got to arguably the cheapest it's ever been, had no returns for 30 years. No one wanted it, super cheap, single digit PE ratio. And, then you had the DeepSeek news and people were started freaking out. They're like, oh my God, China's going to beat us. And, but they lifted the whole stock market for a couple of years. So it's hard to know what's the right amount, but one of the benefits of buying the haystack, as Bogle would say, is you guaranteed to own it for better or worse.
So it's impossible to know what the return on invested capital is going to be. But what do you think is priced into markets right now? And how are you thinking about whether that bogey that's priced into markets right now of how much money is going to continue to be spent and how much money is going to be made by those capital investments, particularly into US data centers? How are you assessing the odds that bogey is going to be met or exceeded?
We did a study where we wrote a book many years ago looking at global valuations of all the countries in the world. And I mentioned the US is at 40. Now it's not end of the year. We still got a month and a half to go. But when a country ended the year at a PE ratio, 10-year PE ratio of 40 or above, which has happened a handful of times in history. China and India were there in 2007, US 99, on and on. Not once have the returns been above average going forward for the next 10 years. So the odds are low that the market valuation today is going to work out for you for the next decade. And it's dominated. If you look at the top 10, top 20 stocks, it's all US flag and it's almost all tech. One of my favorite charts is you go back every decade and you look at the top 10 stocks, not just in the US, you could do it globally. And 10 years ago, there was a bunch of China in there. In 1980s, all Japan. Different times, there was different companies. Maybe it was Exxon and others, on and on. And the names change, right? And so in the 1920s in the US, there was a giant bubble in railroads, right? And utilities. And talk about getting hot and bothered. Imagine getting hot and bothered and paying 60 times for a bunch of railroads, but that was their AI of the day. So on average, look, we're wicked expensive. The great news is there's plenty of other choices. In the US, you could do equal weight. So just say, I'm going to break that market cap link. You could say, hey, we're going to do value or shareholder yield. I mean, mid cap and small cap have underperformed forever. Biotech's underperformed. The obviously foreign and emerging, you could move into, if you look at this, like, the cheapest bucket, it's a Grand Canyon wide spread. And hey, look, even bonds, T-bills, you got some yield like you didn't have in 2022 to help you out. So there's a lot of choices elsewhere in the world, but I think on average, the people that are buying in at these valuations for these companies and more specifically the broad market are likely to be disappointed.
And that statistic you cited about how once a PE ratio gets over 40, there's never been a single instance where it either hasn't outperformed or it has where it either has outperformed or it hasn't underperformed. Do you find that underperformance has a catalyst, or does it kind of just happen because the valuations are so extreme?
I think the catalyst is always obvious in retrospect. Think back to 2000. I was in college and there was a kind of a dual bubble. So it wasn't just internet stocks, it was also biotech and we were sequencing the genome, and everyone was going crazy for both of those. And I remember going on spring break, and I can't remember if it was Bill or Hillary, but somebody gave a speech, probably Bill. And in the speech, he's like, you can't patent the genome. And come back from spring break and all these stocks were down like 20, 50% or something, right? So people used it as the excuse, right? Like it wasn't like it changed nothing. Like everyone knew you couldn't patent the genome. Like that was never the case. Like that was already baked into markets. It was just like it was like when everyone rushes for the exit at the same time. Someone yells fire and then everyone goes. So it feels like that today. Like, I talk to most of my friends in the investing world, even people who have positions, a lot of these companies, and they know stocks are expensive. Like there's no scenario where they're like, you know what, they're screaming cheap. You know what, this is. I don't hear you, Meb. They're like, I know. I'm just like it. They're still going up. Like I feel I can be the one to exit the party first. Like I'll know. Like I'll be able to get out. But what happens is like very quietly, you blink and you'll look around and you say, wow, when did all these stocks go down 50%? And you're seeing some of that already, right? Or like, wow, like when did that go down 75%? Holy cow! Like that didn't take long. So I think it could be a similar situation on what the catalyst might be, or there could be a catalyst. Who knows? We invade Venezuela next week. China takes over Taiwan. Find out there's aliens on the moon that have been watching us. The robots go rogue and AI goes crazy. Like who knows? But one of my favorite charts on the stock market, and we're building this back to 1600, but you see the one in the US back to 1900, where it's like every year is the crisis: Vietnam War, nuclear bombs, World War II, Spanish flu, on and on, right? And yet, relentlessly, the global stock market goes up 10% a year ish, rounding up. Because I'm an optimist,
Mhm.
and it doesn't sound like it, but I'm an optimist. And so I think there's the excuse and the geopolitics and what happens will be like, there'll be a thing we'll market in history, but I don't know that there has to be one. It's just eventually, the weight, the gravity of these positions, eventually causes the Jenga tower to kind of topple over.
I want to know your thoughts, Meb, on whether specifically AI and AI data center capital expenditure is in a bubble. And there's two definitions: hard definition, soft definition. Hard definition is I'm making my bubble call, and I think that this is going to severely correct within a short period of time. That is a strict definition. You can also give the more soft definition, which is I think this will end badly, and the bubble could continue to inflate for a while, but this is unsustainable, and this is not a normal thing of affairs. So, I want to know your thoughts to that question, and
I,
I guess what's similar to previous bubbles right now, and what's dissimilar.
I'm going to channel one of my all-time favorite investors, Charlie Munger, and just
Me
say,
too.
I don't know. I got nothing to add here, really, of really interest to the listeners. But what's similar to other periods? We wrote a paper on this called "What If Sir Isaac Newton Was a Trend Follower?" This is like 20 years ago. I don't even know when I wrote this paper, but saying, look, there's been all these bubbles in history. GMO, great study of bubbles. So there was like 20 different ones we looked at, and we simply said, let's say you think you might be in a bubble or you're in one, but you don't want to get off too early. Like bubbles are some of the most amazing times to make a ton of money in markets, right? If you think back to the 90s, it went on for, years after Alan Greenspan said irrational exuberance. We just, meanwhile, for the first time in 20 years, we had a Fed chair come out and say the stock market's expensive with Jerome recently, but it went on for 2 more years, right? So had you jumped out, you would have missed amazing period. And so the trend following side of us, and we got 3 trend following funds and probably more to come, says, hey, can you apply a quantitative statistical analysis that keeps you in, but at some point says we're out, right? And so the trend, so like if you go back 100 years, this is one of my favorite ways to think about this. And you say, is the stock market expensive or cheap, uptrend or downtrend? And the best bucket historically, the best quadrant has been a cheap uptrend, but second best has been an expensive uptrend, which is where we are now. And the problem is the worst is an expensive downtrend, right? So it's kind of yellow light, like we're going up. When the market rolls over, to me, that's red light. And the problem with most of our friends is they don't have any exit criteria. They buy investments and they say, I'll just wing it and I'll when my gut tells me to sell, which is always the worst way to do it. So we have a parachute on these type of things. Now, most of the momentum and trend in equity markets is up everywhere this year. Now, it's actually tilting foreign, but in general, it's all equities straight up. So you want to still be able to, because the analysis going back to Newton was that he was an investor in South Seas stock. And the bubbles, the chart goes vertical at some point, whether it's a stock, a market, a sector, whatever. And whether it's a 2x, a 10x, a 100x, whatever it is. And then you have the inevitable backside of Mount Everest where it just crashes. And the example we gave with Newton was that he was an investor and then he made good money and he sold, but then his damn friends were bragging and it kept going up and he got sucked back in and then it crashed and he lost all his money, right? And so he has a great quote where he's like, I can calculate the path of orbital mechanics of stars, but I can't track the madness of men. And so you have things like, where the US stock market's going up, but if we were to do this in a couple of years and you say, Meb, you remember when we were talking about stocks are expensive at 40? Well, now they're at 60, now they're at 80. And I'll say, hot damn, it's not out of the question. And but the value side will start to say, hey, yellow light. And then the trend will say, actually, no, it's time to get out. So, but we're not there yet today. But to us, that's and by the way, the trend type of investment, it'll never get you out of the top, right? So trend by definition, it waits for some retracement and then exits. And so you'll never perfectly time it and get out at the peak, but you will save your hide. And so the example with Newton, the example with all the other markets is the haymaker, and the thing that crushes everyone is the giant losses, the down 80, down 100, right? Down 20, people can survive. But if you lose all your chips, you can't play anymore. You're out of the casino, they kick you out, right? You can't bet. Same thing in financial markets. So avoiding the catastrophic losses, because the power law works both ways, right? If you lose 50%, listeners, that's not 50 to get back to even, it's 100. You lose 75%, it keeps getting worse and worse. It's 300% to get back to even. So I think avoiding the really big losses is key here in the boom times. And so for us, it's the combo of, and this applies on an allocation level too. We wrote an old paper called Trinity Portfolio, where we say, look, the problem with trend following is that people, you end up looking different a lot, and you're wrong a lot. So people don't like low batting averages, but putting those two together, value and trend, we think is the perfect combo.
That is really interesting that expensive and uptrend outperforms cheap and downtrend.
It is
Uh,
interesting, but that's the thing with trend. The trend, both trend and value, have been around for over 100 years. Charles Dow on the trend side talking about it. We just did a documentary on trend on YouTube. Y'all can find. It's kind of fun. It's kind of less in the mainstream, though it has been at various periods in history the past 100 years where people have talked about it. I mean, look, there's famous trend followers that have bought baseball teams. So it's a little bit less popularized than value and Warren Buffett and others, but there's a lot of trend followers out there that have made, incredible amounts of wealth in markets. And we talk about a lot of them on the podcast. And but it's a different methodology. And you could argue, philosophically speaking, S&P 500 market cap weighting is trend. Like that's the most basic trend following algorithm you could ever find, just applied to stocks.
So the idea of using trend following to get out, it says rather than human judgment or human analysis of timing the top, we're going to look at when is the trend ending. So you mentioned that this year the trend is positive, and a month ago I would have not had no further questions, nothing to add. The Charlie Munger quote, but the recent churn. How is the trend algorithms interpreting the recent churn in markets over the past few weeks? The
We
trend
have a
still change?
global momentum strategy that, and this goes back to my very first academic paper, a quantitative approach to tactical asset allocation, free to download online. And this paper kind of popularized a very simple trend following approach, something like the 200-day moving average. And, trend in general, it just tells you when to exit. And the big benefit of trend reduces volatility, reduces the drawdowns of portfolio. Now you could combine momentum and trend. So say what's the best momentum? And so we'll look at global assets, for example, and say what's the best performing assets over the last year, and we'll only invest in them if they're above their trend. And so that portfolio can be 100% cash and bonds, or it can be 100% invested like it is today. And you guys can go look it up on our Cambria Funds website and see exactly what it holds every day. But the thing is, you can usually guess what a trend following type of fund will hold. Like it's like everyone knows gold's at 4,000. So it's probably every trend follower is probably long gold, right? So this portfolio is largely stocks with a smattering of precious metals and miners and things like that. But most of the stocks are ex-US, right? Most of the exposure is outside the United States. So despite the fact the US is up 15% this year, or was doing great, great trends, great performance, there's things that are better, and so foreign and emerging up, I don't know, 25, 30 this year. And the cheap stuff, the really cheap stuff is up 50. So there's been a little bit of a rotational shift. Doesn't mean you've done poorly in US stocks, but it also is telling you where not to hang out. It's saying you don't want to hang out in bonds. Bonds haven't been doing as good. Some REITs have not been doing as good. Other commodities have not been doing as good, on and on. And at some point it'll shift to something else. One more quote
Yeah,
on that. And this
yeah.
this is this is the stat that kind of burns this home. I said this on Bloomberg the other day. I said, no one's going to believe this because they got the U.S. stock S&P blinders on. But I said the global deep value and the strategy I'm referring to, the ETF where we manage, has been outperforming the S&P over the last 1, 3, and 5 years. So very quietly, you've had this shift that no one's noticing. And part of that is because it did so terrible the 10 years prior, right? Like, that. But my argument, and one of my favorite papers the last 5 years we've written was called The Bear Market and Diversification, was that it went on for so long. This was arguably been the worst period in history for a diversified portfolio relative to the S&P. Only thing even comparable is post World War II. But I think it's ended. I actually think over the last year or two, you've seen the shift and it's starting to move away from the US. No one's noticed it yet because the US is still near all time highs, which isn't a bad sign, by the way. We had another paper called Is Investing at All Time Highs a Good Idea? No, it's a great idea. There's nothing wrong with all time highs. It just happens to be things are moving elsewhere.
Thank you for that, Meb. Moving to another topic, do you think that institutional investors and particular endowments have been over allocated to alternatives, mainly private equity, real estate, and increasingly private debt?
Well, this is a funny bone topic for me. We have long picked on our poor friends at CalPERS and even some like Harvard, but most of these real money institutions that manage 10, 100, 500 billion dollars, this is real deal money. You would assume that these institutions with the most resources in the world, access to the top managers, access to unlimited amounts of spending power, should be able to kind of dominate in their our portfolios. And the long history is the reality. Most of them don't. And so we've written articles over the years. One's called "Should CalPERS Fire Everyone and buy some ETFs?" And the conclusion was yes, they should. Another one was, should Harvard be managed by a robot? And the answer is yes, it should. On and on. And so we model out historically. We say, look, here's an asset allocation. You could just buy these ETFs and you'll match what they did. It got to the point where I said, you know what, enough's enough. We launched our own endowment style ETF this year. It's got about 150 million in it, ENDW. And the goal is every June 30th, when these guys report their performance, they're going to say Yale, Harvard, CalPERS, on and on. And then you now have an investable benchmark to compare yourself to. And I say, look, if you guys can't beat me, which is a low cost, less than 50 basis point ETF, liquid, tax efficient, then what are you doing? Right? Like why are you going through all this complexity? CalPERS position sheet is like 500 pages. There was a period where they couldn't even calculate the returns on their portfolio. They didn't know. They couldn't figure it out. It was too complicated.
How is that
I've,
possible? Is
I've applied
derivatives or
for
privates? Yeah.
I've applied for their CIO job 3 times, and they've yet to entertain me for even an interview because I tell them, I said, look, I'll actually work for free, but I'm going to fire everyone and replace all these private funds that are paying, your buddies, your college buddies, 2 and 20, and I'm going to replace them with ETFs and save you hundreds of millions of dollars in fees per year and probably fire most of your investing team. So that message, not surprisingly, is mostly a political appointment. So it's actually, there's no I in the CIO. Anyway, but the good news is you can now compare our fund to what these massive endowments and real money institutions are doing. And it's going to be embarrassing, I think, in 3, 5, 10 years when everyone in the committee starts to print out, hey, here's Meb's Morningstar fund. You guys, you can't beat this. So what are we doing here? Anyway, I sympathize with him. It's an almost insolvable problem. If you think you're Harvard, you have like 6 different constituents that are interested, and you have not just current students, past students, future students, you have employees, you have teachers, on and on. And they all have their own incentives on what they do. I have an old article where it's funny because when the returns are great, everyone used to lose their mind in the Harvard Crimson because they paid their employees too much, right? They had like an in-house hedge fund, but it would save them money because they weren't paying outside managers 2 and 20, but there were people making millions and tens of millions of dollars. They said, this is crazy. We can't do this. And then when Harvard would underperform, they said, our endowment's underperforming. What's going on? This is unacceptable, right? So it's like you can't have it both ways, but it solves that problem by just buying some ETFs, making it transparent, and moving on. So I think, could private credit become a giant mess? I think it could. The bigger problem, and so we talked about equities and how they're expensive. Everyone knows that's well understood. That's one of those scenarios where uh, that's a well understood, well discussed phenomenon. Now, I'll tell you something that's not well understood or not well discussed, and that's fixed income. So, we did a paper called T bills and chill most of the time, where we looked at a couple years ago. You had this really long period where the yield curve was inverted. So, 10-year, 30-year US bonds yielded less than short term bonds, which historically is not a good place to be. And by the way, historically is a great sign that precious metals and gold and cash do fantastic. And what have we had? We've had gold shoot through the roof, right? But you have this scenario where all of a sudden all these riskier bonds are either yielding very little above T bills or nothing. And historically, like I said, does that make sense? And so we went and tested it for the past 100 years in all these bond markets. Very much like stocks, does it make sense to pay 200 times revenue for a company on average? It's a horrific idea. It's like one of the worst ideas you could do. Every once in a while, though, so that equity curve, it just loses money. Every once in a while, it does a face ripper, and then it goes back down and loses money consistently for another 30 years. Same thing is true in bonds. Like, it's actually a horrible idea to invest in risky bonds when you're not getting enough margin of safety. So if you look at corporates right now, very little spread to T-bills, some of the lowest since the 90s. Junk, emerging markets, even quasi things like REITs, TIPS, mortgage back, on and on. So we launched a strategy based on this and said, we'll look at 10 sleeves of the risky bond market. We'll only move into them when we feel like it's warranted based on the spread versus T-bills. That fund, since launch and continuing today, is 100% in T-bills, which is rare. That's actually a pretty rare scenario. So either the entire curve of risky fixed income needs to move up, or the short end needs to move way down, or both, for that to normalize until we're willing to take on those positions. Very quietly, a lot of the long bond investors are still down 20, 30, 40%. Add on inflation, it's worse. Imagine if stocks were down 20, 30, 40, people would be going crazy. But bond investors are built, they got a screw loose. They're a little different. But to me, that entire area, and it's probably even worse in private credit, in leveraged, in certain areas that are illiquid. But we'll find out in a couple of years what these marks are. I think it's the last place on the world that I would want to be allocated is private credit. To me, that is the least interesting, zero attractive idea in all of the investing world.
So I looked through your endowments ETF, and it appeared to me that the holdings are at least optically somewhat different than probably what Harvard, Yale, and the big endowments do. Because I know some of those endowments have 50% of their entire portfolio in private equity, private debt, and real estate. And most of your stuff is in stocks as well as some real estate, but it's not like you're allocating towards alternatives or buying the general partner traded stocks like Apollo or something like that. So are you saying that basically public is better than private? Is that the bet that you're making?
No. And in fact, I spend a lot of my time doing angel investing. I've invested in over 400 companies now over the past 12 plus years. There's some reasons for that, and we can get into it. But I think it's important to be asset class agnostic. Most investors aren't. They got their pet asset class. It could be U.S. stocks, it could be tech, it could be I'm a dividend investor. I only invest in fixed income, whatever. And that's a problem because you become emotionally attached and you lose your objectivity. Same thing with politics. We said on Twitter, you identify with a political party, I don't care which one, your IQ immediately goes down 20 points. Same thing with being an investor and saying, look, you need to be asset class agnostic and understand returns can come anywhere, and these asset classes can be great sometimes and terrible other times. So there's nothing inherently wrong with private equity, private credit, on and on. But historically, the academic research shows that you can replicate private equity and venture capital in the public markets, and it's actually not hard. The biggest problem with both of these is the fees. And this is true about everything in the investing world. Look, can you charge 2 and 20 and create alpha? Yes, but that just makes the bar get higher and higher. Look at the entire history of the public fund marketplace. Morningstar, Bogle, others put out this research. The single best factor in all of investing in public markets, if you're doing funds, is the one that predicts performance better than any other indicator is just fees, right? You want to be in at least the bottom half, but hopefully the bottom quartile of fees. The high fee funds, traditionally, there is no better indicator on what's going to suck it up than that. And the same thing is true in private markets. Now, there's two often repeated phrases which we think are extremely dangerous when it comes to private markets. The first is, yes, but there's top quartile persistence. The good funds keep being the good funds over and over in the future. And I think that seduces everyone, into assuming they can pick the top quartile, right? Like it's not like the other 75% of people assume, hey, well, I'm guessing I'm going to be in the bottom 75%. Like, no, 100% of people assume they're going to be in the top 25%, right? So, and that's not the way it works out. And then the second, of course, is the fantasy that the volatility doesn't exist. So there's a recent ETF that launched that is replicating PE VC industry, and they say we can replicate the returns of PE VC. However, the factors we use and to achieve that, we're going to leverage this exposure to the stock market 2.5 times. Okay. So if you think about the volatility in that portfolio, volatility of stocks, let's call it 18%. So to replicate what they're doing, you're talking about like 30, 40% volatility. Like it's multiples bigger. And so you'll see some of these, disingenuous marketers that out there that claim, oh, our private equity, our private credit's got an 8 vol, it's got a 4 vol, on and on. That is definitely not going to be the case. It is if you only peak once a year, but then public markets are too. If you only look once a year, the volatility may not be what you think it is. So could we have a big messy dump here at some point in the future? AQR wrote a fun paper on private equity where they said the perfect complement to private equity is trend following. And yet I've never met a private equity manager on the planet ever that allocates to managed futures or even knows what trend following is. There's like two. There's like two of them.
So you personally invested in over 400 companies. Nothing wrong with private equity, private debt. But why are you saying that public equities right now with your endowments ETF is going to beat the endowments that are so heavily into alternatives and private equity, private debt.
Yeah. So if you look at how we allocate, two things. One, historically, is you can replicate the endowments, piece of cake. First of all, 60/40 replicates Nakubo endowment average, right? We're trying to replicate like the Yales of the world, right? Like, so the best of breed. And so there's two things that portfolio does. One is, and we wrote a book, we've written a couple books on this, but global asset allocation and then the Ivy portfolio. But basically, you can replicate the endowment portfolio. It's an equity focus, so very heavy in equities. It has a real asset exposure, which most US investors don't have. So, talking about commodities, commodity equities, REITs, TIPS, on and on. And both, remember, both Swenson and others have mentioned, L. Arian and others who have managed the Yale and Harvard endowments. Here's an ETF portfolio you could do to track what the endowments do, right? So, they published those in the past. The second part is a global exposure, so it's not just US, and they usually have very little fixed income. But for us, the portfolio is leveraged to around 140%. Okay. So it does have leverage embedded in that portfolio. We add things like value tilts, we add things like quality tilts, we add things like trend and managed futures. So ours is definitely going to look different than the Nakubo average. But I think the equity focus and the leverage will get us in the same ballpark. And the good news is, listeners, you can go check out our holdings every day on the website. The beauty of an ETF is they got full transparency. So the endowments, it's a little harder to figure out what they own and when, but they usually write a yearly report and talk about it. And for sure, they are quite a bit different. It'd be fun to watch. Yale recently announced they're selling a giant portion of their private equity portfolio. And also, it'll be interesting to see how much impact if they continue to be taxed and become a taxable portfolio, because taxable is a lot different than tax exempt. You can run things in a slightly different way, and that'll be curious to see how that plays out.
So you think that basically private equity, it's in the name, equity, can be replicated with public equity, and there's nothing special about private equity, and everyone says, "Oh my god, we got this special company. I've got this special company, blah blah blah." But like you add them up to the thousands of companies, and they have the very similar economic characteristics to a small cap or a mid cap stock.
Yeah, and you can even add a little value tilt helps. I think a little quality tilt helps. You can also do sector based. So if you want to tilt more towards VC, the portfolio, you say, let's do a sector bias towards tech and healthcare, on and on. So there's a lot of academic papers out there on this topic, and the vast majority demonstrate that, yeah, you can replicate all the various private equity VC indexes, broadly speaking, with public equities. The problem is that everyone in the media, the journalists, they'll write about the private equity or the VC fund that returned 20x.
Yeah.
Like, oh my God, see, look at this one, this outlier. But that's not the broad market. And there's a lot of people out there. I'm blanking on the foundation that wrote about this, but they're like, we've been doing private equity and VC for like 30 plus years. And they're like, and we have sucked at it. Like it hasn't even outperformed S&P. And they're like, we've invested in like hundreds of these funds, and they're like, our experience is probably, more typical than I think most people think.
So you think that the endowments that are so deep into the alternatives, private equity, private credit, should take on a lot more ETFs. Unsurprisingly, the alternative managers disagree with you, and they actually want the reverse. They think that individual investors and retail investors, people represented by the wealth through the wealth channels and the like, they should now be getting into these golden opportunities, the golden age of private credit, and this fantastic private equity. What
Let
part of
me
it? What?
clarify that a little bit.
Yeah.
I was at a recent conference and I was chatting with a few ladies, and they ran a few of the famous endowments and real money institutions you would know. And we were talking, and I said, "Oh, it was happy hour. They're having some wine." I said, "Oh, we just launched an endowment ETF," and I got these icy cold stares at me. And I said, "Well, look, you guys, you have nothing to fear from me, right? Like, I think it's currently, I'd have to look it up, 30 basis points all in, 40 basis points or something." And I said, to be clear, like, you should be able to beat me. Like, that's what you get paid 1 million, 5 million, $10 million for. Right? DW has a 0% wrapper, so we charge nothing, but the underlying fund fees, and this varies over time. So if you look at our other ETFs, GAA, TRTY, they're usually around a third. They could be in the 40s, they could be in the 20s. They'll kind of bat around depending on what we own. And hopefully they go down over time. And on top of that, we do short lending, which adds some more to that. But they're below 50. Anyway, but I said, ladies, you have nothing to fear from me. If you're good, and that's the whole point of paying you $5 million. And the whole point of you paying private equity and VCs 2 and 20 is you should be able to beat me. That's the whole point of your job, is to deliver alpha and outperform the idiot's guide to asset allocation, which is what I'm doing, right? This is the dummy's guide. Anyone on the planet can buy the same ETFs we do. Anyone can buy our ETF. Again, 0% wrapper, but you should be able to beat me. Do I think that most of you will? No, I don't. In fact, I think at least 2/3 of you, maybe more, will underperform this investable benchmark. But I think that's true with most of investing, right? And so this is why you see all these active fund managers year after year in public markets underperform just a broad index, is because those really high expenses become a inevitable drag. And it's something like half of public markets close over the course of a decade. So I think it wasn't well received. They kind of turned back and walked away. But I said, look, I'm not saying don't invest in private equity. I'm not saying don't, but you just have to have the conviction that what you're investing is going to work and it's going to do a good job. And if it does, God bless you, you earn that money. But if it doesn't, we got an ETF for you.
Meb, the one thing where I'm trying to think like, okay, a lot of what I'm saying with Meb, I agree with. So, for the sake of
That's
having,
no fun. It's more
yeah,
fun when we
exactly, exactly. One
disagree.
thing I'm like, okay, the one thing private equity can do that ETFs can't do, I don't think, is with their liability structure, they can issue debt that's 3 years, 5 years, and have flexible financing terms. Whereas, me in my personal account, people watching this in their personal accounts, and probably imagine you in your, the ETFs with leverage, that's mark to market. So you have a lot less flexibility. Would it ever be possible in an ETF to sort of issue a longer term debt so it wouldn't be marked to market, margin debt? Or is that kind of just like, never would be allowed because it's not the point of the ETF?
There's a lot of solutions, particularly for the rich folks, on how to leverage your balance sheet to get portfolio lines of credit, to do box spreads, and you essentially get funding at the funding rate, which is incredible, right? So there's plenty of ways to lever up if you want. I mean, the futures markets, the option markets are efficient already. So I think there's a lot of ability to do that. We often tell people, I mean, this goes back to a piece Bridgewater wrote forever ago when they were talking about their all-weather portfolio, which, by the way, you can also replicate with a basket of ETFs, and which, by the way, they now have an
Yeah,
ETF,
yeah.
and unfortunately, for some reason, they charge 80 basis points on it, which I think was a huge missed opportunity for them. But the interesting part they actually talked about was, say, look, there's no reason to accept asset classes at the volatility level at which they're packaged and presented to you. And the point that I was referring to is that the S&P is leveraged already, right? The companies have debt on their balance sheet. Now, if you wanted to lower the volatility and exposure of the S&P, you simply cut it with some cash. So you do 80% S&P, 20% cash, 50% S&P, 50% cash, and you shift around the volatility of that portfolio. The same is true with bonds. You can lever them up, you can lever them down. And so once you equalize all asset classes and you can target whatever vol you want, 10, 20, whatever you want to do, then it just becomes a question of returns and correlations. And you start to go down this path of optimizing an asset portfolio, and it leads you to a couple places that I think are pretty interesting. One is where a lot of these risk parity folks talk about, is you end up with a much more diversified portfolio across things like real assets and global assets. And second, to me, and I'm the biggest outlier in the entire world on this, I've never met anyone that shares this opinion, is that trend following and managed futures as a diversifier to that traditional allocation, if you put it through the optimizer, you usually end up with like a third or half in trend or managed futures. And no one does that, right? Like if you do trend and managed futures at all, you end up with like 5% or 10% if you're crazy. And it's interesting right now because managed futures has been through one of the worst periods of the last 30 years. It might be the worst on a rolling 12-month basis if you look at the SocGen Trend Index. So a great opportunity, listeners, to add some trend and managed futures exposure. But to me, that's one of the biggest outliers. So same thing with when you think about how to put together a portfolio, you don't have to accept things as they come prepackaged. So you can lever up, and that, I mean, look, this goes back to Markowitz, levering up and down the security market line on how you do leverage, no leverage. It applies to not just your portfolio, but individual assets too.
And one thing I think is very important for individual investors and taxable investors is tax liabilities. And I think that's something that's totally undercovered on almost all financial media and including my show. Tell us about these 351 ETFs. I've started hearing about this earlier this year. I, what are they and how do they?
Yeah, you saved the fun part for last. Look, I mean, it's interesting. It's fascinating. It's sexy to talk about the investing world. Hey, is gold going to 6,000? Is Bitcoin going to 1 million? Is it going to zero? What are stocks expensive? All this fun stuff we talked about for the last hour. But the reality is, like, the lever of taxes, the impact of taxes is vastly easier alpha to generate than on the investing side. And let me give you an example. Forever, people have been investing in mutual funds and taxable accounts. We did a post the other day on our blog and on Twitter. We said there's like $1 trillion in asset allocation mutual funds in the US, many of which that charge 50 basis points, 1%, 1.5%, right? And then we know for a fact that ETFs are much more tax efficient than mutual funds. When we were talking to Bank of America on the podcast, they estimated that the fee and tax benefit per year of moving from mutual fund to ETF is well over 1 percentage point. So a percentage point per year of returns just by the structure. Okay. But there's still $1 trillion in these funds that are high fee and tax inefficient. Every year, this time of year, Morningstar puts out an article and they outline these mutual funds that are doing 20%, 50% capital gain distributions. Like, are you crazy? This is like coal in your stocking, like the worst possible outcome. And yet people still do it because usually they're lazy, the money's in it, they're not going to sell it, or they have capital gains. And so usually it only happens with death, divorce, or bear markets is when the money leaves, but it doesn't go back. No one goes back to paying 2% for some crappy mutual fund. But if you're in a bunch of stocks or ETFs already and you're sitting on a 10 bagger, a 100 bagger, I think the Qs have been a 20 bagger since 2009. What can you do? And most people say, look, I have two choices. I can pay the taxes and just suck it up, sell all these Mag 7 stocks I got that are highly appreciated and I know are expensive and I don't want them. I'm just going to sell it and I'm going to take it. Or second, people say, look, I can't sell it. Taxman's going to kill me. I just can't do it. Can't do it. And so they sit in it. And if we know anything about investing, on average, concentrated investments are a horrible, terrible, no good, very bad idea. Now, you have your outlier friends who put all their money in Fartcoin or Nvidia or something and they made a bunch of money. But on average, it's a horrible idea. You can ask all the people that invested in Enron, CMGI, Lucent, on and on and on. Terrible idea to put all your money in one stock or a few stocks. And so, but they're stuck. Like, people in general will say, well, there's nothing I can do. It sounds like an infomercial. It's like, just wait till now. Here's a solution. And so it turns out there's a part of the tax code called 351, which has been around longer than you and I have been alive. But it really only recently found its perfect partner with the ETF structure, and particularly post 2019 ETF rule. And the basics of it, we tell people, if you're familiar with 1031s in real estate, which has been a generational builder of wealth for decades, where someone buys a building or a hotel or something and they hold it for 30 years. They got all these cap gains on it, and then they sell it. They can roll it into another property and it's tax deferred. You don't have to pay taxes on it. Incredible, right? Like crazy. I think a lot of people don't even know that exists. Well, you can do this with stocks. So let's say you have a portfolio of 20 stocks. They've gone up a ton the past decade. You want to sell them, but you can't. So you can seed the launch of an ETF. So we've done 3 of these. We're about to do our 4th in December. So the first one was tax. The second one was ENDW, the endowment strategy. The third was GEW, which is global stocks. And next up is USEW, which is a US stock fund. So basically, you submit a portfolio of stocks or ETFs. So it's got to be publicly tradable, liquid. So no futures, options, no mutual funds, hedge funds, Dogecoin, on and on. And you get the ETF back. And the cool part, and that's tax deferred. You're not wiping the gains, but you're getting a diversified ETF in return, which can then rebalance going forward, and you can hold as long as your heart desires. Now, the regulators in their foresight said, look, because this is a registered investment company, we don't want people doing this for tax reasons alone. Now, we know it's good to get out of concentrated positions. Theoretically, it's fantastic for the health of the broad market because it lets you recycle highly appreciated, expensive positions into the rest of the stocks in the marketplace. So theoretically, it could start to help damper investment euphorias and booms, but TBD if it's widely adopted. So there's two rules. One is you can't just contribute all your NVIDIA. So the max position size for one position is 25%.
Mhm.
And second, the top 5 positions can't be above 50. So basically, you either need 12 stocks or more, or, and this is a huge kicker, ETFs are pass through. So theoretically, you could contribute 100% SPY if you wanted because it owns 500 companies, it's diversified, on and on. And so we've tried to been educating the world on this. 99% of people have never heard of it. We have a tab on our website if you go to Cambria Funds that's got PDFs and videos and everything. But it's a really interesting use case for a lot of people. For one, concentrated stock, direct indexing, strategic rebalancing, but also for the financial advisors listening, it's a really interesting biz dev idea because you can go out and talk to a lot of people and companies and VCs and private equity people and say, we have this idea and solution that you can opt into. Along with our friends at ETF Architect, we're the only ones we know doing it open enrollment. Almost everyone to date has done it, has been their own little silo of money, like DFA taking a mutual fund and moving to an ETF, or a hedge fund moving to ETF. We're saying, hey, anyone can contribute to this. And so the next one we'll do is probably next spring. So if you're interested, reach out. Sorry you missed this one because the deadline was this week, but I think it's going to hit mainstream next year, big time in 2026.
But to what degree does the stocks that are contributed affect the strategy? Like, let's say I'm super into, let's say, there's someone who's has $100 million and they're are very concentrated in, Australian airport stocks or something extremely niche. Is that going to shape the allocations of everyone else who was like, oh, I thought it would just be something a little more vanilla?
Sure. So we laid out a buffet of 4 choices because I said, look, I don't know what people are going to want to diversify into. I have my beliefs. I know what I would do, but I also don't know exactly what people want. So we're going to kind of, like any new development and rollout, we're going to get feedback and we're going to build on it from there. And so we launched 4 funds we would have launched anyway. Okay. And so I'll give you an example of the fund we just did, which was GEW. And that's a global stock fund. So for that one, it's 25 basis points all in, no other fees. So for that fund, and it's not market cap weighted. So there's not actually, weirdly enough, there's no global equal weight style ETF. You got over 100 billion of them in the US, but none abroad. You have ACWI, but again, market cap weighted, which we don't want, and certainly not at 25 basis points. Anyway, but you could only contribute global equities. For the prior fund, the endowment style, because it invests in anything, it's fixed income, it's real estate, it's commodities, it's stocks, you could contribute a lot more things. And then for the US fund that's coming out next month, you can only contribute US stocks. So we're not taking foreign stocks, we're not taking Bitcoin or anything else, right? So it needs to match the prospectus. And second, so the interesting part is already, so for this next fund, the correlation of what's contributed, and we won't know till we finalize the portfolios, it'll be diversified, it'll be US large cap stocks. So already the correlation should be above 90%, maybe even 90% day one. So already you're kind of already there. And then it's a question of like, hey, can we, update this? It's actively managed fund. Maybe we keep all the stocks, maybe we sell some of them, we'll see. But I think it's a lot closer than what most people would assume from the get-go. But we also control that. So, by definition, like theoretically, if everyone in the world wanted to only contribute NVIDIA, remember we can't get any more than 25% just because of the diversification rules. But in reality, that's never the case, right? Though NVIDIA is what, 7% of the US market already. So it's probably going to be more market like, and we can control that too. I think on the last one, we maybe had 800 different positions or something. So it tends to be pretty diverse. And direct indexing, interestingly enough, is a perfect off ramp if you're long only, because if after a few years you only have gains. Now, so for next year, we're doing 2 onboardings for global stocks, one in the spring and one in fall. And then if you come to us and if you're an advisor, and we've had a lot of these conversations, so you'll probably see a few of these, and you want a custom one, you say, look, I got 500 million, I got $1 billion across my clients. Hey, Meb, I know you do shareholder yield. Can you do a global shareholder yield fund? Or hey, could you maybe do I don't know, another allocation fund that's focused on family offices? Like, we're open to this conversation. So y'all reach out if you got any good ideas for us.
But what if the stocks that are contributed are not compliant or aligned with the strategy? Do you sell them and buy stocks that are aligned with the strategy?
Well, if they're not compliant with the broad strategy, we wouldn't accept them. So we're not going to take your junior miner from Vancouver or some $10 million biotech stock you got that you just want to puke out. We're not going to take a 2x NVIDIA fund. We're not going to take, all sorts of nonsense. But it's like any active strategy. We rebalance, and in the next rebalance, if there's stuff in there we don't want, we'll sell it, and there's stuff we would rather buy at the next opportunity, we'll rotate into it. And that's the beauty of the ETF structure. The creation and redemption process is a tax deferred process. So, the S&P SPY has made rebalances once a quarter forever, 30 years now, and it's never paid a capital gains distribution. So the ETF structure is magic for this type of setup.
So yeah, just to put a point on it, like if you had a value ETF and 18% of the stocks that were put into this ETF were Palantir, which of course, 500 PE, not a value stock. Within a quarter or something, there would be a rebalancing out in order to have a value.
Yeah, I can't guarantee what our exact methodology would be because this is a hypothetical, but of course, I doubt we would ever accept that much Palantir. Palantir folks don't want to sell their stock anyway. You watch him throwing swords on Twitter and everything else. Nobody's selling that stock. Anyway, but yeah, so you can move. You could certainly, if it doesn't fit the methodology, you could, translate to where you're trying to get to. Same as any active strategy or quantitative strategy. So sure, theoretically, yes.
That makes sense. We'll leave it there. Meb, thanks so much for coming on Monetary Matters. People can find you on Twitter and we'll link to your website. I also really appreciate your service, The Idea Farm, where you've tagged me multiple times. So I really appreciate that.
Great. Thanks for having me.
My pleasure. Thanks everyone for listening. A reminder to leave a rating and review on Apple Podcasts and Spotify. And of course, subscribe to the Monetary Matters YouTube channel. Thanks again. Thank you everyone for listening. Remember to check out CAIA NXT to level up your knowledge of alternatives today. Visit the link in the description to get a 10% discount and learn about what's next for your clients.